Hi everyone, in this video we'll be going over A-Level Accounting 2022 October-November Paper 2-1 question number 3. This is a structured paper 2 which consists of 4 questions. 2 of them are of 30 marks and 2 of them are of 15 marks. We are also given a time limit of 1 hour and 30 minutes. And since question number 3 is of 15 marks, ideally we should be spending about 15 minutes in order to complete this question. And in this video as well, we will be attempting to solve this question under 15 minutes. Now, without any further delay, let's get started. The directors of H Limited provided the following details from the Statement of Financial Position at 30 September 2021. We're given the equity and reserve section. We can see that we're given the values for ordinary share capital, share premium, and retained earnings. Then, during the year ended 30 September 2022, the following transactions took place. On the date of 1st November 2021, the company paid a final dividend of 0.06 per ordinary share. Let's figure out the total value of the dividend paid. In order to figure out the total dividend, we just need to multiply the rate per ordinary share to the total number of ordinary shares, right? And we can see that we are given the total value of ordinary shares as well as the nominal rate. So in order to figure out our number of ordinary shares, we just need to divide the total value by the nominal rate. In this case, that's going to be 200,000, which is the total value of ordinary shares, and the nominal rate is 0.50. So this gives the total number of ordinary shares in H Limited to be 400,000. Now let's figure out the total dividend paid. That is just going to be the rate per ordinary share, which in this case is 0.06, times the total number of ordinary shares, which we just figured out to be 400,000. Now our total dividend paid on the date of 1st November 2021 is going to be 0.06 times 400,000, which results in the value of 24,000. Alright, then on the date of 1st January 2022, the company made a rights issue of 2 ordinary shares for every 5 shares held. So this just means that for every 5 ordinary shares in our company, the company provided 2 new rights shares. Let's utilize our unitary method. That is just going to be 1 ordinary shares will get 2 by 5 rights shares, right? And we already figured out that the total number of ordinary shares is 400,000. Now let's figure out the number of rights shares for these ordinary shares. So that will be 400,000 ordinary shares. We'll be getting 2 by 5 times 400,000 rights shares. This means that on the date of 1st January 2022, the company will be providing 2 by 5 times 400,000, which is 160,000 rights shares. Okay, then the price of issuance is 0.60, but we can see that our nominal rate is 0.50. So this just means that the ordinary shares will get increased by the nominal rate. So in order to figure out the total value, we just multiply the number of rights shares by the nominal rate, which in this case is 160,000 times 0.50, which results in the value of 80,000. Now the remaining extra value is going to be premium, right? So let's figure out the premium value. That is just the difference between the issuance rate and the nominal rate. In this case, our issuance rate is 0.60 minus the nominal rate is 0.50, which results in our premium per share to be 0.10. Now let's figure out the total value to be included in our share premium. That is again going to be the total number of rights shares times our premium rate per share, which in this case is 160,000 times 0.10, which results in the value of 16,000. All right. Now, for the date of 1st July 2022, the company paid an interim dividend of 0.02 per ordinary share. Now, the number of ordinary shares has been changed because we issued new rights shares, right? So previously, we had 400,000 ordinary shares, right? Let's write it down. The previous value is 400,000. And the new value or the new number of shares that we issued as rights shares is 160,000, right? So this should also be included in order to figure out the new number of ordinary shares. Now this gives the total number of ordinary shares at the date of 1st July 2022 to have the value of 560,000. Now let's figure out the value of our interim dividend. That is just going to be the dividend rate per ordinary share, which is 0.02. times the total number of ordinary shares, which in this case is 560,000. Now this gives the interim dividend paid at the date of 1st July 2022 to have the value of 11,200. Now at the last date, which we have is 31st August 2022, the company made a bonus issue of 1 ordinary share for every 4 shares held. Okay, I'm just going to write it down right here. This just means that for every 4 ordinary shares in our company, the company will issue 1 new bonus share, which means that for 1 ordinary share, it will be getting 1 by 4 bonus shares, right? And we already figured out that the total number of ordinary shares at that date is 560,000. So we need to figure out the number of bonus shares corresponding to that value. So for 560,000 ordinary shares, the company will be providing 1 by 4 times 560,000 bonus shares. This results in the value of 140,000. So this just means that at the date of 31st August 2022, the company made a bonus issue of 140,000 new ordinary shares, right? And the directors decided to leave the reserves in the most flexible form, which means that this bonus issuance will be funded by our share premium, and if it is not enough, then it will be funded by our retained earnings. So let's figure out the total value to be included in our ordinary shares corresponding to these number of shares. Remember that bonus issue will always be made at the nominal rate because we are essentially funding it from our reserves, so we will not be providing any sort of premiums, right? So that will just be the total number of shares which we issued, which is 140,000, times the nominal rate, which is 0.50. So this bonus issuance will increase our ordinary share value by 140,000 times 0.50, which is 70,000. Now let's have a look at our first question. We need to prepare journal entries to record the transactions 1 to 4, and the dates and narratives are not required. Okay, let's move back to our first transaction again. We paid a final dividend, right? Dividend is basically an expense for a company because we're paying it out to our shareholders, and expenses are always recorded on the debit side in our journal entries, right? So the debit side will have the heading of dividend. And while paying out the dividend, our bank balance of the company is being reduced by that corresponding amount, right? Because we need to pay out cash of 24,000. The reduction in bank balance is always represented on the credit side in our journal entry, which means that the first transaction will have the journal entry of dividend paid on the debit side and bank account on the credit side with the balance of 24,000 for each side. Let's write it down. We have our dividends paid, which was of 24,000. And while paying this dividend, our bank account will get reduced by the same value. Let's move towards our second transaction. We made a rights issue of 2 ordinary shares for every 5 shares held at a price of 0.60. And while making any sort of issue of new ordinary shares, our capital increases, right? And we can see that in our capital or equity, our ordinary share is being increased by 80,000 and our share premium is being increased by 16,000. And always remember that increment in assets are recorded on the debit side in our journal entries, whereas the increment in liabilities and equities are recorded on the credit side. Which means that in order to record this transaction in our journal entry, we need to record our share capital with a value of 80,000 on the credit side, as well as the share premium with a value of 16,000 on the credit side. Now let's talk about the debit side. While there is an increment in capital, this basically means that there is a cash inflow in our business, right? And the inflows will be recorded in our bank account because those shareholders will be paying this amount of 80,000 as our ordinary share and 16,000 as the share premium into the bank account of H Limited, which means that the bank balance will increase, and that increment in our bank balance is to be recorded on the debit side in the journal entry. And remember, our bank balance will be increased by 80,000 plus 16,000. So on our debit side, we will be recording bank with the amount 96,000, and on the credit side, we'll be recording our share capital with the value 80,000 and share premium with the value 16,000. Let's write it down. That's going to be bank with the amount of 96,000. And this 96,000 is funded by our share capital, and it only funds the 80,000 value, and the remaining value is funded by our share premium with the amount of 16,000. Okay, let's have a look at our third transaction. Again, this relates to dividend. Like I said before, dividends are expenses, and expenses are to be recorded on the debit side in our journal entries. So again, our entry is going to be dividend paid with the amount of dividend, which is 11,200. And while paying out this dividend, obviously our bank balance decreases, which should be recorded on the credit side with the same amount of 11,200. Let's write it down. So that is dividends paid with the amount of 11,200, and our bank balance will be decreased by the same amount. Now let's have a look at our fourth transaction. We made bonus issue of 1 ordinary share for every 4 shares held. And we already figured out that due to this bonus issue, our ordinary share will be increased by 70,000. And ordinary share is part of our equity, and the increments in equities are always to be recorded on the credit side, which means that while recording the journal entry for this fourth transaction, we should be recording share capital with the amount of 70,000 on the credit side, right? And bonus issue is funded by our reserves, which is basically the share premium and retained earnings. So let's have a look above. We can see that the opening balance of the share premium is 50,000, but we also made a rights issue. So that brings in 16,000 as our share premium. Let's add its value. That's 15,000 plus 16,000, which results in the value of 66,000. So if you were to fund this bonus issue by share premium only, out of 70,000, only 66,000 will be funded by the share premium. And while it is being funded by the share premium, this value of 66,000 will be deducted from our share premium, which means that there is a reduction in equity which should be recorded on the debit side. So share premium with the value 66,000 will be recorded on the debit side. Now, there is also the remaining balance, right? The remaining balance is 70,000 minus 66,000, which results in 4,000. Now, this should also be funded by our reserve. And the next reserve we have is our retained earnings, which means that we will be decreasing 4,000 from our retained earnings. Again, retained earnings is a part of equity, and the reduction in equities are to be recorded on the debit side. So, in order to record the fourth transaction on the debit side, we need to include our share premium with the value 66,000, retained earnings with the value 4,000, and on the credit side, our share capital will get increased with the value of 70,000. Let's write it down. That is going to be the share premium with the value of 66,000. Then we have our retained earnings with the value 4,000, which increases our share capital by the value of 70,000. Alright, this concludes the first part. We can now move towards the second one. We need to state 3 reasons why a company may make a bonus issue of shares. Previously, we saw that bonus issue is being funded by our reserves of the company and basically from our share premium, which is a capital reserve. So what we can say is that the bonus issue of shares enables the company to liquidate our capital reserves, which cannot be used to pay dividends, because we basically cannot use our share premium to pay dividends. We can only use our retained earnings, right? So that could be a reason. Let's write it down. Enables the company to liquidate capital reserves that cannot be used to pay dividends. Secondly, bonus issue of shares is also a form of dividend because we are providing additional ordinary shares to the existing shareholders, right? And dividends or cash dividend are paid when we have enough cash in the company. But when the company needs to preserve cash, it could issue bonus shares as the dividends. Let's write it down. Issued in place of cash dividends when there is a need to preserve cash. And thirdly, since we fund our bonus issue from the existing reserves, we do not have to involve any outside parties to look over the whole issuance process, which makes it a less expensive process as compared to our rights issue or a new share issue. Let's write it down. It is less expensive than a rights issue or new share issue. This concludes the second part. We can now move towards the third one. We need to state two features of preference shares. So the distinctive feature is that ordinary shares will get a variable rate of return because it depends on the profit or loss that the company makes in that particular year, right? But in case of preference shares, they will always get a fixed rate of dividend, which is mentioned while issuing those preference shares. Let's write it down. Shareholders receive a fixed rate of dividend. And the another difference between our ordinary shares and preference shares is that ordinary shareholders have voting rights. But in case of preference shareholders, they do not get any sort of voting rights. So that is also a feature. Let's write it down. Shareholders have no voting rights. Alright, this concludes the third part of this question as well as this entire question number 3 of 2022 October-November paper 2-1. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.